Hey everyone, it's Ben here, and today we're going to be going over part three of the LBO tutorial series that I've been doing. And so you can see on the left here, we have the simple LBO model, then we have part one, then part two. If you're new to the whole series, then essentially Burger King was acquired by a private equity firm many, many years ago. And in part one, we go through the actual transaction assumptions and gather everything and all the key information that we need. And then we basically have just been building upon that part one. And so this is now part three. Um, in this video, so what we're going to be going over, there are some errors that I actually found from part two. They're really small, so they don't really affect the whole analysis, but still it will be good to just fix those. I want to add preferred stock, go through adding a pro forma balance sheet. Pro forma just means after acquisition, essentially. And then sensitivity tables and adding a DCF. There are some other things that I mentioned in previous videos that I would go through with you guys, but I decided not to, and I'll kind of explain why. So, revenue cases, I kind of realized we already have these two cases of conservative and management. So, not really super additive, I think, to add more revenue cases and all that stuff. So I decided to take that out. Separate historicals tab. As I was kind of like playing around with all the numbers and everything, I realized it would mess up a bunch of the model, and I also don't think that it really adds much. Management incentives. I think I just decided to take it out for the sake of time, to be honest. And then LIBOR. So LIBOR, I actually was looking this up. I didn't realize that the finance world or markets or whatever stopped using it. They have replaced it with other metrics. But since I'm not as familiar with like the other metrics and methodologies, I didn't want to lead people astray, so I took it out. So those are the things we've taken out, but the remaining stuff we have here still should take up at least an hour. So a lot to work on. A few notes before getting started. So this model will be available for free to download as usual after the stream ends if you look at the description. And then you can also sign up for an investment banking community I recently launched called or on the school platform. Actually, I'll just click onto it for now. And then if you once you guys get this Excel, and you'll be able to look at all the different kind of videos that are related, like different LBO tutorials, private equity video playlists, etc. And then any of my socials if if you guys want to. Before I do get started though with the model itself, I do want to let you guys know about today's sponsor for the video, Wharton/Wall Street Prep. And so they have a private equity certificate program that they run 3 times a year. And right now, as of today, actually, is the early registration deadline, January 13th, 2025, 2025, which will waive $200 if you do sign up now or today, I guess. But this certificate program is very unique in that it's where kind of theory meets practice. And it's in collaboration with a lot of the top private equity firms like Carlyle, you saw here, maybe here also you see Blackstone, KKR. And then if you go down a little further, you'll see the instructors who are actually kind of like teaching this program. So you'll see David Rubenstein, who's the founder of Carlyle, and then Martin Brand, who is head of private equity at Blackstone. So computer's a little laggy, I think. Hopefully you guys can see this all okay. But it's like an 8-week program. You kind of are taught at your own pace. Speakers are down there, but first, if you guys want to kind of see what's in the course curriculum, there's kind of like an intro to PE and the asset class, the PE investment framework, deal process, modeling, bunch of stuff in here. And then here again are the speakers. So you see like David Rubenstein here, Martin Brand, the people I mentioned. And then the last thing I want to mention here is that what's kind of cool about this program is that there are peer-to-peer networking events that are in person. There's also like an Wall Street Prep Wharton invitation only group. And then there are exclusive recruiting events from the top headhunters. these are the headhunters that actually reached out to me when I was at JP Morgan. And what's also last thing I'll mention that's not super obvious here is that all of the previous cohorts for this program and then the other Wharton/Wall Street Prep certificate programs, everyone's kind of an alumni in a sense, and then you're kind of plugged into this like alumni group. So if you want to check it out, be sure to use my code rareliquid. You'll get $300 off, and if you sign up by the early registration deadline, then an additional $200. Depending on when you watch this video, that early registration $200 off may or may not be available. All right, so that is the sponsor of the video, and now let's go into making changes into our LBO. So if you see here, first thing that we want to do is fix the model errors. So I found a few errors as I was kind of working through or preparing for this video. So I wanted to change them really quickly, and it shouldn't take too long. So the first is plant property and equipment. So it kind of was a while since I've done part 2. So then as I was looking at this, I don't remember exactly why I did it this way, but I feel like there must have been a reason. But essentially, the problem is that if you look, the beginning balance should always equal the ending balance. Or the current year beginning balance should be the ending balance of last year. So this essentially, I keep saying essentially, this should equal this, right? But right now it's hard coded to something else. I feel like I probably did that in order to make the numbers tie somewhere. But because these numbers actually don't affect the model at all, I thought this was pretty misleading. And so what I wanted to do was just kind of get rid of these. And then the ending balance here can be found on the balance sheet right now. So go to plant property and equipment. 2010, it ends with 104.1, 101.4.1, right? So which is this one. So I'm just pasted back the comment there. So this is the ending balance as of 2020. Wait a minute. Oh, oops. This is actually the ending balance for 2010. I wanted to add that there. Just double check that these numbers are. Just double checking something. So in order to be as accurate as possible, I prepared the model that we're looking through right now and wanted to reference it a little bit. Make sure everything's fine. Okay, so yes. Give it 1014, this is the end of 2010. And then I wanted to basically get back into the beginning balance. So that would be ending balance plus depreciation minus capital expenditures. Then Alt HFC to make this black. So now this all makes sense. So 1014 is the ending balance of PP&E. And then this kind of links all correctly. And so now we don't have an issue. So basically that's what I wanted to do. I wanted to delete that part. So PP&E is done. Then ending loan balance. I noticed this really small error that I wanted to fix in the debt schedule. So we're to go down to our, actually this is kind of a big error, I realized, but it didn't really affect too much. So, or luckily didn't affect too much because we don't have like that much mandatory debt pay down and whatnot. So, but let's say I make this 10. This should be subtracting out the mandatory debt payment, but it's not right now. So basically, we just need to subtract that out. Yeah. So what we need to do here is just minus and then subtract this mandatory pay down part and then copy paste this across. Same issue here. And with this, we can actually just copy paste this. So yeah, again here, just subtracting out mandatory payment. And then same thing here. Coordinated notes doesn't have that issue, I believe. Yeah. Okay, so that's it. So other thing that I realized is this can also be really confusing. You know, it says false, but we can also see, you know, if this is actually an issue or not by increasing the number of zeros here to the fourth decimal. So sometimes because of iterative calculations the with Excel, it'll say that it's false, even though it's off by maybe like 0.0000000001 or something like that. If you subtract, you know, if you do this check right now, and you see that the result is pretty much 4 decimal points of 0, you can pretty much assume that this is all working correctly. So that's fixed. That's error number 2. And then the beginning debt balance. So this I realized is adding the ending balance for our subordinated note here. So this should actually be linked to our beginning balance. And then that's all fixed now. So Alt ESF formula. Also, I realized I should have added the keyboard shortcuts. I don't remember how to do that though. It's gonna take me a second, but let me do that so that you guys can see what shortcuts I'm using. I always forget which application it is. Maybe I can like go to history of apps. Hmm. Okay, actually. I have some screens up here and stuff, so let me just change. Oh yeah, it's called KeyViz. Okay. While this is loading, let's go through the rest of the model and changes. So the next thing that I wanted to add to the model was preferred stock. So this is another source and addition to the capital structure. So let's just add it here first, and then it's going to kind of bleed in throughout the rest of the model. So preferred stock for capital structure, you only have two types really, which is debt and equity. And right now we're assuming that we have, these 5 tranches of potential debt, and then we have just common equity. But then preferred equity is another type of equity that has a lot of unique kind of features, let's call it. And you can do a lot of different things with it. But for us, we're going to first of all assume that we have 0. We can play around with it later. But if I added a comment here that it's just illustrative. And then so in terms of EBITDA turns, it'll just be 0. For interest, we'll assume the same 10% here. But again, this is just for like to build additional functionality. And so it's not going to actually matter what this interest rate is for the purposes of like the rest of this model. Fees, let's also call it 0%. It'll be 0 in fees, which obviously is not really realistic because in reality you will pay fees. Term 5 years, again, amortization will have 0. Okay, and then so preferred equity is now part of the capital structure, and then now we're going to have to add it to our sources because we're basically assuming that we have not only, or potentially have not only raised money or borrowed money through the revolver and the different term loans that we have, etc., but also potentially could raise with preferred stock as well. So right here, I'm going to press Alt HIR to get preferred equity, or to add our preferred equity line. And let me just add the keyboard shortcut thing. Downloading right now. Okay, there we go. You guys should be able to see it now. So preferred equity can just basically copy this down. And again, it's not going to affect anything for now because we're assuming that everything for this is 0. But if you're watching this and you're maybe thinking that you're going to one day recruit for private equity or something, then you may need to model this in. So it'll be helpful. Okay, so preferred equity now is in our sources and uses. And we can go down to now our debt schedule that we have here. And then we're going to add it at the end. Even though preferred equity is not debt, it'll be something that is kind of like has debt features, and that's why we're adding it to this section. I think from your guys' end also, by the way, there should be no lag, but then on my computer, it's a little bit laggy, so that's why I might be going a little bit slow here. But what we are adding now here is just like an preferred equity section. So for now, I'm just going to copy paste this down. This is linked. We got to link this to our preferred equity, which is all the way up at the top. Okay, so then we have beginning balance. We don't have mandatory pay down for preferred equity, but we do have something called PIK accrual. And it's similar to our PIK interest. PIK, if you're unfamiliar with, it stands for payment in kind. And instead of necessarily generating interest, um, like our subordinated notes here, like it can add the interest in by adding to principal. So preferred equity also has that potential kind of feature. And then there's also like a dividend kind of option as well. So that's why preferred equity can be a little bit uh, tricky and then also just very beneficial for private equity investors because it gives them a lot of flexibility. And I know a lot of this might be a little bit confusing because everything's pretty high level, but let me like walk you guys through adding this line item first, and then as I go through the actual numbers, but when we are like playing around with them, then things should make a lot more sense. So the first thing I want to do is start with our ending balance, which is 0, right? So let's go to the top and then link this to our sources and uses section. I guess it doesn't matter that much, but let's do it in our capital structure section. So the amount we're starting with is 0 at the time of the transaction. Beginning balance is our ending balance from the previous year. And then PIK accrual. So similar to what we did here, if you remember from part 2, if the PIK interest toggle is on, then we want to start accruing PIK. I guess I call it principal. Otherwise, what we want to do is have it be 0. So the formula here is if PIK equals, call it 1. Let me actually check something real quick. Let's scroll back to the top. So we have our toggle here. And so this was just for subordinated notes, but now I'm going to call this the PIK, just for PIK in general. And then 1 switches it to cash. Okay. I'll PIK toggle. Okay, so if this switch is on 1, then basically we're going to be taking from, we're going to be using the cash interest. And then if it's on 2, then we're using the, then we're adding the PIK interest. Okay, so I think we can just build this out in a similar way as our subordinated notes. So if you see here, what we did last time is if PIK equals 2, so if it's on the PIK toggle or case or whatever, then we're getting L32, which is all the way up there, but it's our PIK interest rate times G247, this beginning balance minus mandatory payment pay down. So basically just the remaining balance. So keeping that in mind, I think what we can first actually do to take a shortcut is copy paste this down here. And so what this is saying is, so if PIK equals to, if the PIK thing is on, then let's get our PIK interest rate, multiply it by our beginning balance, which is at 255. If not, give us 0. So I know it's 0 right now. It looks like we did nothing, but I'll show you guys what all this does in a bit. Um, okay, so beginning balance, pick accrual, ending balance, and then dividends. So as I was mentioning a little bit earlier, for preferred stock, there's a lot of different things you can kind of do with it. And one of the things that preferred stock holders enjoy is being paid dividends on a consistent basis. And so that can be for just other companies, but also for private equity firms. They may want to add preferred stock as part of the capital structure because it gives the private equity investors an option to pay themselves dividends, which is basically just like a cash payment every year. And so that can help basically kind of like boost their returns. What we're going to do here is, again, if pick equals one, pick equals one. So if our pick switch is turned on to one, which is cash, then let's get the ending balance and then multiply it by our interest rate, which is all the way up there. Let's go grab that. Okay, so it's here, preferred equity interest rate. So we're going to treat this as just our um, cash or dividend rate or whatever. So if the switch is on, then multiply our ending balance times our dividend rate, let's call it, and then otherwise give us 0. Then now we can multiply this across because everything has been built out. And everything is 0 now, but let me just really quickly just, make this, actually, sorry. Wait. Yeah, we can do it right now. There are other adjustments we need to make, but I think, let me just show you what this looks like now. So if we make this 100, and then we have our toggle onto cash, then when we go down, you can see here now that beginning balance is at 100, and then pick accrual is 0 because this pick accrual switches off, but there's a cash dividend here of 10, right? Which we need to link to our cash available for debt pay down. But I just wanted to show you guys this for now. And then if we scroll all the way back up and go to our switch here, and then toggle this to 2, and then now so it's getting it's using our pick interest now. So now you'll see that the pick accrual is happening, right? So I promised I would explain things a little bit more now that we have the numbers. So let me do that. So pick is a feature of certain types of debt or preferred equity where instead of paying off interest right away, the pick will accrue over time and be added to the principal of the debt, or the preferred equity in this case. So you can just see here, the beginning balance principal is 100, pick accrual rate is 5%, which is 5 million in this case. And so it adds to the principal, and then it just keeps adding and adding. So it does keep getting bigger and bigger over time. It's a bigger debt obligation you have to pay off at the end. So it's a little like potentially risky, but if you would rather use your cash as a business to pay down other tranches of debt or to fund your business operations and growth, and you feel like that growth rate will be higher than the PIK interest rate, then that's the time when you actually want to have PIK interest. Or for debt investors, they may want to have it because it gives them a higher interest rate. And so maybe you as a private equity firm need to take on more debt, and PIK interest may be kind of like one of the few options you have in order to lever up the company more. So it really, depending on your use case and all that, PIK interest could be good for you, could not be. And so, but it is just something that's commonly tested on in private equity interviews and is used in the industry. So hopefully this all makes sense. But let's now go back and turn the preferred equity back to 0, because we're using real numbers for that were used in this transaction, and there was no preferred equity used in the real transaction. Okay, we're almost done with preferred equity, but because the cash is being spent at the end here. Another thing I should mention is that in terms of capital structure, your debt is paid out first, and then your equity is after, right? Debt, preferred equity, and then common equity. And then within that, there's like a hierarchy as well. I mentioned that if we have a dividend, then you're paying out cash to your investors. And so what that means is that you have less cash to actually pay down debt. You have less cash to fund your operations, and etc. Right? So we can't just like leave this here and not have it affect anything else in the model. So what we need to do is add this line to our cash flow statement section. So if we go to this line here, 185, we have mandatory debt repayments. And then right underneath, we're going to add a dividends paid line. So Alt HIR. So let's just call this dividends. And I think these were highlighted last time because I kind of thought like we're going to make more changes to them and stuff. But right now, as they are, they should be all functional and working. So I'm just going to press Alt HHN to turn off the highlights. Okay, so double check this though. Revolvers there, discretionary payments. Okay. All right. Everything's working because net change in cash is 0. So, and it should be because right now you have a lot more debt to pay off than cash flow. So then your net change in cash should be 0 with what we built out, because all your cash should be used right now to pay off debt. Okay, so let's just link to our dividends, which is all the way down there. Copy paste this across. And then let's make it purple in order to note that it's linking to the same sheet. Okay, so that is your preferred stock. And I guess like really quickly, I can just show you guys what we kind of did and what it looks like. So if I change preferred equity to 100, and then I change the pick toggle to cash, so dividends, then what you'll notice go down. Oh, actually, sorry. We need to make one more change. So I was wondering why our IRR wasn't going down. So we need to actually link this to our pre-revolver cash flow. So what this is doing now, it's getting our cash from operations minus our cash from investing when we're spending money and stuff like that, and then subtracting out our mandatory debt repayments and then subtracting out our dividends. And since we have less cash that we're using to pay down debt, this should result in a lower IRR. But depending on how you look at it, also, you're getting cash back. And so you're not actually losing IRR. But you can see here that it went from 22.9% to 5%, 22.5%. So our IRR has come down a little bit. Let's make this 0 again. And then you guys should see it will go back to 22.9% or 21.2%. Oh, interesting. Preferred equity actually increases your IRR. Why that is? Preferred equity. Oh, it's probably because by adding preferred equity, it lowers the cash that you need to invest for sponsor equity. And because we're using so much leverage, it probably just amplifies your returns. Yeah. Okay, so now everything's working though. And let's see what we have here. So we fixed our model so far. We added in preferred stock. And then the next kind of tricky thing, this is probably gonna take is the trickiest part of this whole part 3 is the pro forma balance sheet. So this is going to be an entirely new section at the very bottom. And this isn't actually going to affect our analysis, but I think it'll be just like an interesting exercise for everyone, for all of you guys watching to kind of go through. So what I'm going to do first is just kind of organize the formatting. Okay, so interest rate, or sorry, what I'm going to do is copy this, go down. I'm going to call this pro forma balance sheet. Okay, so we have our pro forma balance sheet that we're creating here. And let's kind of explain what we're doing. We're going to be like, whenever a transaction happens, you have the company's prior to acquisition balance sheet. And then, especially with this acquisition where so much debt is added onto the balance sheet for the target company, you have a ton of new debt added, you have goodwill, you have like a lot of these different line items, right? So what we want to do here is basically create the new balance sheet to see what it's going to look like after the acquisition. So we're going to have 2010 actual, and then we can delete all this actually. I think we can start this here. So we're going to have use of funds, sources of funds, then some accounting, and then this is pro forma 2010. Expected. So pro forma meaning just after the acquisition. Okay, so then what we basically need to do here is just get all of the line items first for in our balance sheet. And so we can start off with cash, then accounts receivable, or actually we can go up to the balance sheet line items that we worked on in part 2. So in working capital here, we have all the different line items And we looked through the entire balance sheet to get all of the line items for Burger King in the past. And so we can just copy this. We can basically just take everything here is I guess what I'm saying. And that'll fill up not the entire balance sheet, but a lot of the current a lot of the operating working capital line items. So what I'm going to do is going to look a little weird, but I'm just going to copy paste this down so that we can get the line items kind of quickly. So we don't need this stuff, but we do need prepaid and other current assets. So that'll be the assets section. And then we will also be working on the liability section after, right? And accounts payable is the liabilities, and so is accrued advertising. And then other accrued liabilities, obviously also another liability. And then we have the long-lived assets that we projected again in a previous part. So let's go to our long-lived assets, which is taking me a bit to find, but let me keep going, scrolling. Okay, so sorry, my computer is like lagging. So when I press certain buttons, it shows up later. And so right now it's kind of like going all over the place. Okay, let me try this again. So equals, I'm going to press page up, scroll up. Okay, so yeah, here we are. So we need our PP&E and then intangible assets, goodwill and other assets, other liabilities. So we're going to need all this stuff. And so I'm going to copy this or enter this. Do the same thing as before, but now we need to move the liabilities down. This may not be like the most efficient way to do this, but it's just the way I'm going to be doing it. Okay. Again, copy paste this down. We have PP&E. We don't need all this stuff. We have intangible assets. We have goodwill and other assets. And then we have other liabilities, which will go at the very end. We also have debt. Okay. Actually, I'm going to put other liabilities down here. Oops. All right. And so this will be total assets. This will be total liabilities. And then the other thing that we need to add here is our preferred stock, which for this one, I guess we don't need to like copy paste that much for this one. So I'm just going to just do it this way. Okay, so now we have the different sections of the balance sheet. We have assets, liabilities, and equity. What we need now is to just pull these items essentially. So for cash, I think a really easy way to do this actually should be if we just kind of copy paste this. Should pull in the numbers. Yeah, it does. Except for this one, actually. We have the numbers, but it's a matter of we need just the 2010 number. I'm gonna try to kind of locate that. Okay, so it's actually this first one. So this was a bit of a shortcut, but I'm still gonna double check everything and walk you guys through what this is. So, but first thing, I'm going to make these all purple to indicate that they come from the same sheet. And then let's start actually with cash. So 2010 ending balance cash. Let's scroll up to find that number. Okay, so you see cash here is ends at 118, but began at 188. I guess we made this assumption here that we're starting off at 118, but the ending balance was 188, right? So we have 188 accounts receivable at 143. You can see that here. So in our working capital section, we have all the line items here. So working capital is at 143. You know, we have all these different line items for working capital. So that's 143. This is 104. PP&E, to these we actually need from elsewhere. So let's pull this. So PP&E, let's go up to the long-lived assets section. And then the ending balance is 1014 because this is 2010. Let me just double check the year though. Yeah, okay. So 2010, ending balance 1014. And then intangible assets, same thing. Let's go up. Ending balance is at 1025. And then same thing for goodwill and other assets. Let's go up. And then we can see that the number here is 269. Okay, so we have our total assets. What we just need to do is sum these. So equal sum, Control Shift, up arrow key and then down arrow key once. So this gives us our total assets. And then now we need to fill out our liability section. And so later on, we're going to do a check to make sure that these numbers are all correct. So because 2010 was a real year that happened. And so later I'll show you guys that all the numbers that we have here will match up with the actual balance sheet figures in the balance sheet for Burger King when it was acquired. Accounts payable, let's go up, find that in the working capital section. Then accrued advertising, same thing. And other accrued liabilities, I'm just going to take a note here, is 3 lines down. So it's going to be at 126. Instead of going back up, I'm just going to copy this and then make it 126. Then again, I'm going to make this purple. Okay. And so this is all kind of just linking, pretty easy stuff. I guess we also have other liabilities, but let's do debt first. So this is going to be the debt of the company when it was acquired, right? And we have that information. If we go all the way to the top, all the way to the top, we can see that the debt at the time of the transaction was 755. So we can link to that. And then other liabilities, also we can grab questions. So it's at 478. So that wraps up the liability section. And then we can do the same thing. So equal sum, Control Shift up arrow key, close parentheses. That gives us 1613. Double check this number. Okay. But then next, preferred stock, this is going to be 0. Preferred equity, we can just put this. We could hard code it or just put it here as 0. Let me think. Because actually, if we're playing around with the numbers, then this is not going to be 0. I'm going to actually hard code this one since this is something we're just using for the transaction. So I'm going to make this blue since it's a hard code. And then equity. So this is the amount of common stock. It's also known kind of as like just shareholders equity. We are going to actually need to grab this number. So we see here that total equity, total stockholders equity is 1128.4. So we can highlight this, copy it. Then add it to our equity section. And then again, we're going to make this blue since it's a hard code. Okay. Weird. Oh, there's space. Okay, so now we have our equity. I'm going to zoom out of this so you guys can see it better. Okay, so and then what I want to just show you guys is I want to compare these numbers with the actual figures to just basically show you guys that everything should tie. But I will say the total liability section is off a little bit because there's something that we're going to need to add. So what I want to show you though is that, so we have here all the different current assets and then the long-term assets, and it totals to 2747.2, right? Which is actually does not tie. Why does it tie? We have 188, 143, 188, 143, 104 prepaid current assets, which is 88.4 plus 15.1, 1014, 1025, and then goodwill 31. Dude, maybe I see what I might have done wrong here. So this is adding the okay, so 138.5, 104.2 should be adding 31. So another mistake here. But once I change this, this should tie now. And that's why it's also important to actually double check this. So you can see here 2747 and then 2747. And then for the liability section, you can already tell that something's off here, right? 1613, 1618.8. But we're really, really close. So 107 is accounts payable, accrued advertising 71.9, that looks right. The other accrued liabilities 201, that looks right. And then current portion of long-term debt, and then plus this just normal debt, that should equal to our 755. And then 478 other liabilities. So this we actually are going to need to add in order to make everything tie. So let's basically see what the issue is here. So here you can see what we did was we added 65, 65.3, 344.6, 68.2. So actually this is all right. I think what I did differently is that I didn't count all of the capital lease as debt. So actually, if I were to go here and add the 93.3 plus 667.7, that amounts to 761. So that's why we're having a discrepancy here. What I'm going to do as like a little bit of a shortcut, the debt is basically what's wrong here. But we go to this, you'll probably see the note that I have in here where we subtracted out this 5.6. And the reason we did that is I think we're subtracting out our current portion of capital lease, and we're not treating that 5.6 as debt, because capital lease does, depending on how you view it, doesn't have to be classified as debt. So what I'm going to do is add the 5.6 to our other liabilities section as a hard code. Okay, so at 5.6, once we add it, should line up with the 1618.8. So I'm going to just add a note here, adding capital lease current portion. Okay, so we have our total liabilities, we have our total equity. The main check we want to do now here is, does your assets equal your liabilities and equity, right? That's the ultimate check for your balance sheet. So we're getting total assets minus total liabilities minus our equity, and this should be 0. So let's add 4 decimals just to be extra sure. So this is how you can tell that your balance sheet balances, because it's to the 4th decimal is 0, so everything is balancing, which is really what you want to see when you're modeling your balance sheet. Because when it doesn't balance, like, you can't trust your information, and you need to fix it until it's at exactly 0. Okay, so now we have the balance sheet at the time of acquisition for the company. And then what we're going to need next is the use of funds, sources of funds accounting, pro forma, and then to basically get what the balance sheet looks like at the after the acquisition. So let's kind of like go through these one by one. Not all of these are going to be affected. And I'm actually going to do the cash section last. Um, the first thing we're going to, so all of this is going to honestly be a little bit complicated, but I'm going to try to go through things like slowly one by one. So first of all, in terms of what these sections mean. So uses of funds, this is any cash that's used because of the transaction. And then sources of funds is like, where is the actual money coming from? Accounting, there are some basic like accounting issues kind of that are items that we need to just account for and fix. And then all of this basically added together is going to result in our pro forma balance sheet. So basically we're making adjustments to a bunch of these line items. The first one that we're going to need to make an adjustment to is the intangible assets. So if you recall from the previous parts, or maybe if you go back now to the previous LBO videos, which by the way are in the related videos section in the description of this video, part 1 and 2 are there. There were, let me just scroll up to the top and you guys can see. There were some line items that were amortized, that we decided to amortize. And those were the, here, financing fees, and then the other. We didn't amortize the other ones, but for our purposes here, let's assume that we will amortize it in the future, because this other section is kind of like a black box right now that we backed into to get to our 1.56 billion in sponsor equity. But anyway, what this is basically showing, or what we're basically doing here is, in the previous part, there are debt financing fees that are not paid for right away at the time of acquisition and instead are paid year by year, aka amortized. And so what this means is that there is amortization that it needs to be added to the balance sheet and will decrease over time when it's paid off year by year. But once the transaction is actually happening, there's this amortization that needs to be added, right? So this is added here in this section. And then for the next section, another use of funds is debt, right? All of the debt that, because we are doing an LBO, we're actually going to retire all the existing debt. So what we really just need to do is get the negative of the existing debt. And that is negative 755. So that's the liability section. And then everything else is not needed, but then we do need, or everything else in the liability section is fine. But then now we have to go into our equity section. And then I'm going to do equals minus because we're going to be paying off the equity. We're going to be paying off all equity holders. And that's a use of equity, right? So we go to the equity value here. This equity is what we are paying off to our equity holders. And then in order to make all of this basically balance out, what we're going to need to do is just get our cash balance. Oops. And then kind of like back into everything in order to make it all make sense, essentially. So once we, so we're using our cash. Okay, we can start from the bottom. We're using our cash here, using our cash. Oops. So we're using our cash here. So we add this, subtract this. And then that gets us to our use of funds. So we are in here, what we're doing is just figuring out how much of our cash are we using, right? And we're using the 755 to pay off debt. We're using 3.3 billion to pay off equity. And then we're kind of quote unquote gaining 102 million in cash by kind of not having to pay off the amortizing or the financing fees yet at least from like an accounting perspective. Okay. So let me just double check something real quick. Okay. All right. One of my numbers wasn't tying with something else, so I wanted to check what that was. One thing I forgot to add in here is we are paying off our equity, but another thing we're also doing is we have to pay off our transaction fees. So if we go back up to the top, in order to purchase this company, we are paying off all equity holders, and then at the same time, we are paying off all of the transaction fees for these. So we need to add these two together in order to get how much cash is actually being spent in order to buy off all this equity. And so we have this 3417. And then we can do our check again. So multiplying, get our total assets, total liabilities, and then total equity. And then once we copy paste this check across to the right, this should be 0, which it is. So we know that we're at a good place because we are the balance sheet balances. So usually if your balance sheet balances, that pretty much means that you're doing things correctly. Okay. Let's now go into our sources of funds and let's think about like where is all of our money coming from. So sources of funds for the cash section, let's actually do that a little bit later and let's think about like where is our cash coming from. So debt is a huge portion, right? So if we go all the way up, we can see in our capital structure section and then also in the sources and uses section how much debt we're actually taking on, right? So we can go to this section. I did equal sum and we can just sum up this section. This is like all of our debt. And this is where a lot of our money is coming from, right? So 2.6 billion. And then for our preferred stock, maybe once we play around with the numbers and stuff, we may need this to be dynamic. So I'm going to go up here. And then in our sources section, preferred equity 0 for now. Okay. Equity, this is the sponsor equity. So this is how much the private equity firm is actually going to be putting in. That's 1.56 billion. All right. So kind of almost there, and then I'll answer some questions in the chat. So if you have any questions in the chat right now, feel free to ask away. And then I'll get to them all in a bit. But we can see here now, we can think about for cash, where is for all the sources of funds is adding to your cash balance, right? You take on, $2.6 billion in debt, then you have $2.6 billion in cash. That's a source, essentially. If you take on, let's call it $10,000 in student loans, then you get $10,000 in cash, right? But of course, you pay that to the university. But essentially what we need to do here is just simply get our debt and then add And that gets us to our total cash. And again, we can do this check, which is add 0. So this all looks, again, correct. And then for the accounting portion, there's just like a small thing that we need to adjust here. But what we need to do is get our equity value and our book value. So what we're doing here in the goodwill section is we're calculating how much goodwill there should be after this transaction. And the reason we're doing this is that goodwill is basically a plug to e- e- after, if you like look at all the, when you're combining the balance sheet of the previous and now the former after the transaction, usually you're purchasing the company at excess of the company's equity, right? And that leaves a big hole in the balance sheet that needs to be filled up. So let me just show you what I mean first, and then we can actually plug in that hole essentially. So I'm going to get the sum of all of this. So we're summing up these rows. And you guys will be able to see here. Oh, actually, I guess everything. Sorry, doing some formatting here. So adding a line to make things just a little bit more readable. Okay, I misspoke. So the everything, I should have, I guess, like known this, but everything balances out right now because everything balances in our check, right? So then goodwill, I kind of explained that a little poorly. Basically, right now you can see here, for example, that our equity is at negative 728, which makes 0 cents, right? You're not going to have negative equity for a business. And so what we actually want is to get, we have to add back the actual equity that's being kind of added to the equity section, equity line item, and then plug in uh, the whatever that amount is with our goodwill. So that's kind of where the whole plugging in whole concept comes in. So let me just add these things for here real quick. Okay, so what we are going to need to do is get the amount of equity that is paid and then subtract out uh, the shareholders' equity or the book value of equity. So what we need to do is go to the equity value. So go, I guess you can do it in either side, but let's just do it here. So we're going to get the equity actually paid, which is all the way at the very top. It's 3325. And then we're going to subtract the 1128. So it's 2197. And then in order to fill in this 2197, make the balance sheet balance, we're just going to make this equal to that 2197. So that's what I kind of meant here by goodwill. So with that, everything should balance, which it does. And so now we have our pro forma balance sheet. So these are the different adjustments we had to make in order to kind of account for everything. And you can now also see here we have a positive shareholders or book value of equity, which is what you want to see. You don't want to see this being negative. So now we have our pro forma balance sheet. And then make this red. I like putting my checks in red for whatever reason. I'm not used to doing that. Okay, so that is our pro forma balance sheet. And then now I want to add a sensitivity table. So sensitivity tables, if you watch some of the other DCF video streams that I have been covered already. But I thought it would be helpful to kind of do it for the DCF because, or sorry, for the LBO because we just use like slightly different metrics. Okay, so the thing about sensitivity tables is that the formatting tends to need to be a little bit different. So what we usually do is actually get the, or move it to the right hand side over here. So we're going to add sensitivity table. And let's compare. So let me, I guess, first conceptually explaining what sensitivity tables are. They just basically allow you to test out different key assumptions and then kind of like play around with them to see what percent you need or how changing certain assumptions will change your ultimate metric that you want to look at, for which for our case is usually for LBOs IRR, internal rate of return. So let's create maybe one or two of these. What we need to do first here is get our key metric, which for us is IRR, and that's right here. And then we gotta think about, and then we have to think about like what exactly do we want to test for, right? So usually some good ones are like entry multiple and exit multiple. So let's go to our very top. You know, this is like a key entry and exit multiples are key drivers for any LBO, but our entry and exit multiple is actually the same. Because that's usually what you want to, it's like a conservative assumption that you want to make, that you're not having like a higher exit multiple, let's say, than an entry multiple. But either way, let's go to our entry multiple, which is down here. We have it at 8.8. And then the exit multiple is over here at 8.8 as well. It's just equal to each other, right? Sometimes though, things get a little buggy and it'll just be simpler if I hard code this. So I'm going to put Alt HESV or Control C, Alt, and then Control V, or Control C, and then Alt ESV. So this is going to be the, let's call this one the entry multiple. And then down here will be the exit multiple. Okay, so then now what we want to do is subtract our exit multiple here by a certain amount. Let's just do it by 0.5. So let's do this minus 0.5. For that, Since this formatting is getting weird, I'm gonna Control C this, Shift down, arrow key, Alt EST for formatting, and then get this minus 0.5. Okay, so this is basically lower exit multiples, and then on the bottom here, we're having higher exit multiples. And I know if if it's your first time looking at this is going to be kind of like, what are you doing? But everything will make sense once we get to the end. This one, same thing. But in the corner here, you actually want to have your smallest figure, and then on the bottom right, your largest. And so what that means is for entry multiple, for the left-hand side, we actually want to have a higher entry multiple because that's going to be what is more, that's going to result in a lower IRR. So again, I'm going to copy paste the formatting here. I'm going to add 0.5 on this direction to the left. Right. All right. And let's do a little bit of formatting. So usually these are gray. And then there's borders that are added. Oops. So I'm going to add an outside border, Alt HB, outside borders S. Then add them here too, Alt HBS. And I'm going to make these a little bit skinnier. Alt HOW for the column width. Make this 10. Also make this a little skinnier. Oh, also I realized this needs to go up here. HPS. Okay, almost there, guys. So we have our entry multiple, exit multiple. Maybe I'll format this a little bit more nicely a little later. But let's get to the actual creating the, let's get to actually creating the data table. So what we do here is we highlight this section like this, and then we go to data. So Alt A, and then what if, so W, and then T, data table. And then the row here is this row. So you go to your entry multiple. So we have to scroll all the way to the top. And then we can click the entry multiple. And then the column is the exit multiple. Then once you press OK, the data should populate. Hopefully, if I've done everything correctly, give it a 5-10 seconds. Okay. Cool. So it looks like it worked. Actually, not sure if this worked. Okay, what this should, it actually doesn't look like it may have worked. So figure out why. Okay. So instead of hard coding this, let me actually go back and link it. So entry multiple here. And exit multiple, let's link this here. If this doesn't work, I have another idea as to why. Sometimes these sensitivity tables can be a little funky, but we have all these numbers here, and so let's click F9 to recalculate. Okay, giving us these numbers. I think what the issue here is that the exit multiple is connected to the entry multiple. They're like equals the same thing. So I think that's messing up uh, the entire data table. So um, instead of connecting them, I'm gonna just make it a hard code for the exit multiple, but they're still equals the same thing. So let's now scroll down to the bottom to our data table. Oh, why is this? Huh, weird. Okay, maybe my guess is actually, is our exit multiple not affecting our analysis? Because let's see here. No, it is. Exit multiple 8.8 E24. Entry multiple is also there. Oh, hmm. I think the issue here is that our entry multiple is not driving, it's not actually driving um the IRR. It's being backed into, which is why now I realize that we can't actually use it for the data table. So sorry we just went through that and it was kind of useless, but let's try to find another assumption that we can use that's really driving the model. Let's see. I guess like leverage would be a good one. See if there's a way to do that. Hmm. Maybe machines. I mean, we have a bunch of assumptions, but then not like one or two like really big key drivers like our exit multiple that's just like really driving a lot of things. Um, like I could show you guys an example with maybe one of the key debt tranches. It's not like the most interesting, but it seems maybe it'll be best for now. So I don't know if people would actually or investors would actually do this. I think what they might do is instead have your total leverage, which would be like, oh, maybe this. Hmm. Oh, also I realized this is incorrect. Need to drag this down. Oh, for all of these. Okay. Let me just show you guys with maybe this interest rate. So 6.8%. I guess this will just be a test to see if this sensitivity table is working correctly at all. So entry multiple we can't really use. I'm gonna have this as interest rate of forget what the loan is, but back up. Number is I think this 6.8%, and it's for our secured term loan. So what we're gonna basically sensitize for is see what our IRR looks like with a lower and higher interest rate. So we have 7%. We will have this minus 0.5%. On the other side, we will make this smaller or larger. Add 0.5%. Okay, so you can see that we have interest rate of the loan for the secured term loan, and it's increasing on one side, decreasing on the other. Let's recreate this data table with this. So Alt A V, oops, Alt A W T, and then going back up here for our row, the interest rate of the loan. This. And then for our column, it's the exit multiple. This hopefully should work. See on the bottom here that the data table is calculating. Oh, also let me save before things actually die on me. Okay. Let's go back down to our data table. All right, so this is working. So you can, beforehand, I could tell everything was not working because like entire row of the numbers were the same. And you should always have at the top left the lowest number and then bottom right the highest. So again, we're looking at our IRR. We're looking at the interest rate of loan for secured term loan. Kind of a mouthful. Okay, so what this is basically showing is that if your interest rate for this secured term loan gets higher and your exit multiple is lower, then your IRR, if it's your exit multiple 7.8 and your interest rate is 7.8% for that one term loan, then your IRR is 16.5%. Versus if you exit at a higher exit multiple and then also with lower interest rates, then your IRR could jump up to 25.3. So this is just an easy way for you to kind of just see how your different assumptions are driving your model. I don't love that we had to like look at one loan to build this um, data table, but I guess it'll do. I'm also gonna adjust the formatting a little bit. This is totally not necessary, by the way. I'm just doing it because I'm used to it or used to formatting. I guess we'll have to merge these. Make the formatting. Okay. Okay. 14.5. Alt HOH 14.5. All right, so here's our data table. I'm going to make this skinnier. Go too skinny. So Alt HO W. Make this like 6. Okay. All right, so this is pretty much what the formatting of a data table should look like. Yeah, so hopefully this was helpful. Normally I'd make another one, but then I don't really know if there's like other really good assumptions that we can sensitize for. So this is more for just like you learning how a sensitivity table works. Okay, so now if we look at kind of like our agenda of what we had planned for today, we fixed the model errors, we did preferred stock, we did pro forma balance sheets, sensitivity tables, Now let's kind of as quickly as possible add a DCF. Um, DCF shouldn't be too hard to add because we already have a lot of the information. So I just kind of want to show you guys what the DCF really like kind of what numbers it shows and how that compares to the valuation for the LBO. So if we got to add a new sheet, I'm going to call this DCF. Alt WVG to get rid of the grid lines. Shift spacebar Alt HBO to add the underline there. And then I'm going to make this 3. Call this DCF. Alt HFS for the font size. Then let me zoom in here for you guys. In order to also kind of like have a bit of a shortcut, I'm going to go to one of the DCFs I built in the past and then just copy paste the formatting. So, okay. Obviously, we don't care about all these errors because we can just delete everything. And we're not going to sensitize on anything, so we can just delete these rows here. Oh, sorry. I promised I would answer questions on the chat. So let me know if you guys have questions on there, but let's see. Okay, just curious, what do you think are probability weighted price targets? Oh, what I think about probability weighted price targets. I guess you're talking about equity research and if they have a probability weighted price target in their equity research reports. And I don't really have much of an opinion about them, to be honest. I think, yeah, I don't really have much of an opinion about it. I do think that generally investors should be thinking in probabilities because you have a price target, the chances that all your assumptions are correct and that you're going to, yeah, that number is going to be relevant in some way is really, really off. So you should just kind of think in ranges, I guess. Um, nice first time, see you live in 3 years after watching videos. On NVIDIA model, maybe I could do another one. See. Big fan of content. I would like to know which of the two you think better: internship, financial due diligence, or evaluation. I guess it depends where the financial due diligence is at. If they're both at Big Four, honestly, they seem pretty similar to me. Okay. Let's now go into the DCF, and this is going to be as of June 30th, because that's what our LBO is also. Looks like there's been an error in the model, but that's why we have our circuit breaker here. Turn this on, this off. Okay, actually, what the heck just happened? Oh, offer value. Oh, oops. I guess I accidentally entered something here. Oh, net diluted size. Added some text here. Net diluted securities. What was it here? We should have our basic shares outstanding plus the dilutive plus the settled. Just double check this. Oh, 130. 138.6. Okay. Sorry about that. All right. So let's just get through this DCF really quickly. So we have our actuals of 2020 or 2010. And then once we get to, we have the 5-year projections. You can just plug in information. Here. Okay, so we can just get our, we can honestly, we don't even need to plug in revenue. We can just start with our EBIT. So we can find our EBIT in our projections. So let's go down. EBIT is here, 2010. And then we have our projections. And I'll make these green in order to indicate that these are from a different sheet. So percent of sales, I guess that's why we would need it. Okay, let's add our sales. We don't really even need that, but it's just a nice to have. So 2010 revenue. And calculate our growth rate. Also get our percentage of sales now. Then tax rate, we can also get from our LBO, from the financials here. So taxes is our EBIT times our tax rate. Oh, I don't know why it says whack. EBIT times tax rate. Why is that whack? What the heck? taxes. EBOT is our EBIT minus our taxes. I guess we honestly don't need our um, historical but year, but we'll just leave it there. Okay, DNA. This is all going to be a similar. It's all going to be similar format as our EBIT there. So let's get our DNA from our cash flow section. Then we can get our CapEx. Then also get our change in net working capital. Let's change the formatting here. I just like to have my negatives in parentheses for out of habit. Okay, so all of these we can show as a percentage of sales. Doesn't really matter to do this, but we'll just do it. Then that gets us to our unlevered free cash flow. We get our EBIT, EBIOT plus our DNA minus our CapEx. Oops. Minus our CapEx, minus our change in net working capital. Then we need to get our weighted average cost of capital. The only other thing that will take a little bit of time. And okay, but yeah, let's do it. So I'm going to, again, add a new sheet. All this whack. And then I'm going to go to an old model and get the whack sheet that I have formatted already. The only tricky thing here is that, oops. We're going to need data from that kind of has passed already. All right, let's see what we're going to be doing. Okay. Okay, market cap. Market cap at the time of closing share price, it was 18.86. If we get this and multiply by our diluted shares, that gives us our market cap. We also delete all of this. Okay. Market cap equals 18.86 times diluted share count. Risk-free rate. That means that we're going to need the 10-year treasury yield on September 1st, 2010. Never really searched back this far before. See if we can actually pull this information. And your treasury yield on September 1st, September 1st, 2010. All right, hopefully we can find it here. All right, 2010, September 1st, 2010. Okay, we have August 30th, 2.72%. I'm going with that. Close enough. 2.72%. Because again, remember we're doing this as of the time of the transaction, so we can't use the current information we have right now. Beta, historical beta. Hopefully this beta on September 1st, 2010. Yeah, this looks like it's going to be super hard to find. Okay, one last place I'll check is FactSet. If not, then we're going to not calculate our own WACC and we're just going to use a percentage that I think makes sense. It's a bit of a shortcut. It's probably what we are going to need to do, but let's just check on FactSet to see. It takes a while to actually load. So let me just build out the rest of the DCF. So two assumptions we're going to need to add in here are terminal growth rate and WACC. And we are doing this because I wanted to show you guys the difference and the comparison of the LBO valuation and the DCF for this particular transaction. But if you are kind of searching for more in-depth DCF materials, like I have a bunch of videos in the live section of my channel with a lot of DCF streams. So this is going to be super, super basic compared to those videos, just as a heads up for you in case you're looking for more. Okay, Anna, actually, you know what? I'm just going to use a number. Okay, so we can check FactSet later, but terminal growth rate, very standard, is 2.5%. And then for WAC, it's a very mature company, and okay, so let's think. Burger King was a very mature company. Their cost of debt are actually this is not the company's cost of debt. For a pretty mature company that is, let's look at their growth rates and margins. Kind of very, very steady. Margins are pretty flat. I would say not a risky per se company, but not a really fast growing one. Average is usually around 10%. I feel like that's pretty fair for Burger King. Let's just see if it's possible to find the historical beta for this company on FactSet. Okay, actually it just can't. It looks like it just died on me. So for time's sake, let's just go with 10%. So let's get our present value of our unlevered free cash flow. I'm not going to bother with mid-year convention or anything like that either. We're just going to discount back by the full year. I'm going to have to add the discount period up here. So what we're going to do here is get our unlevered free cash flow, divide by 1 plus our WACC. Forward to lock it, close parentheses to the power of the year that we're in, which is our discount period up here. That gets our present value of unlevered free cash flow. You can copy paste this across now. And then let's get our terminal value. And then present value of terminal value. Terminal value, we get our last year's free cash flow times 1 plus our terminal growth rate, which is up here. Then divide all this by WACC minus our terminal growth rate. That gets us to that number. Then present value is this, divide by 1 plus your WACC. To the year that you're in. Right, and so that's your present value of your terminal value. And then that leads us to our enterprise value, which is the sum of your present value of unlevered free cash flow and your terminal value. Then we have to add our cash balance, subtract out our debt balance. That gets us to our equity value. Cash, we have collected this information to 188, that 755, then get our enterprise value, add our cash, subtract our debt. That gets us to our equity value. And then fully diluted share count, and then share price. Fully diluted share count here at 139. Share price is 3.4 billion divided by 139. 24.87. And let's change this formatting. All right, $24.87. Surprisingly, actually, so what I wanted to do here is basically show you what the DCF spits out, and then let's do like for reference or offer price for reference. So our offer price is 24. So discount or premium. Get our offer price divided by our share price minus 1. Make this a percentage. So you can see that our share price, our offer price of 24 is actually less than the intrinsic value of the company based on this DCF, but it's pretty close. And actually, it's a little bit surprising. Maybe these numbers are a little bit too optimistic. So let's call this like maybe 11%. Let's call this like 2%. See what that spits out. Okay, that makes it the share price of 20. And then this is a little bit more what I expected, would expect, I mean. So usually the intrinsic, actually, wait, hold on. Share price, $20 per share. No, actually, sorry. 10%, 2.5%. So usually what you do expect is that your DCF for actually all of it really just depends. Sorry, I was kind of going through a bunch of loops in my own head, but typically when a strategic company is looking at a company, then they're going to be usually a little bit more aggressive with the financials, have higher growth rates and better margins because of just like a lot more synergies, like cost synergies. And that'll usually lead to a higher intrinsic price with the DCF for a strategic acquirer versus a private equity firm. In our case here, what this is kind of all spitting out is that if we take the numbers for our LBO and what we project, then we're going to lead to a similar intrinsic value with the companies, with the offer price of $24 per share, which is what in real life 3G offered to acquire Burger King for. So I think, first of all, this is always just a good check to run a DCF with your LBO figures, is kind of think about like, if I think about the intrinsic value of the company, what is it really worth? And that can help guide what your offer price should be. And given that we got an offer price pretty similar to the share price, like I think it's a good sign. You don't want to be 50% off or something like that in either direction. So this is really just a sanity check, not really anything more than that. But I wanted to build this out so you guys could see, how this compares to the LBO offer price, and then how they, you know, I wanted to talk through this kind of connection between the two. But that actually ends the tutorial. This has been a long journey even for me because I had to relearn a lot of things. And there was part one, part two, part three. And if you have gone through all three of them and gotten to this point in the video, then congrats. And I'm impressed that you sat through, so many hours, and hopefully you've been able to build this DCF from scratch up until this point. But that pretty much wraps things up. And I don't really see a bunch of other questions in the uh, chat, but I actually did put Vaseline on my lips because they were very chapped. So that might be what you're seeing. But anyway, thanks guys for tuning in. As always, this, if not by already the time you're watching this Excel will be available to download for free. Just check the video's description or the pinned comment later on. But it'll usually take like a few days or so. But yeah, thanks guys for joining. Hope to catch you all in the next video.